HarperCollins presents The Money Basics, written and read by Peter Komolafe. This book is dedicated to you, the listener. Your success in life is my mission. My hope is that your journey with money will be smooth and prosperous. How to use this book and key terms. The language of personal finance has always been full of jargon and technical terms, making some things that should be simple difficult to understand. If you're looking for an easy way to get your bearings in personal finance, the following list of terms will help familiarize you with some basic concepts and terminology related to money and investments covered in this book. If you're going to take control of your financial future and become your own financial hero, you need to understand the language used in finance. It will initially seem alien, but I promise you, as you grow in confidence, it will become part of your vocabulary. The following terms are used every day by professional investors and ordinary people like you. Feel free to refer back to them as you please. Appreciation. Appreciation is an increase in the value of an asset like a home. Appreciation can be measured by comparing the current market value of the asset to its original cost. For example, if you bought a house for £200,000 and it's now worth £400,000 after 5 years, it's clearly appreciated in value. APR. APR stands for annual percentage rate, which determines how much interest will be paid on a credit facility like a credit card. It's the official rate used to help you understand the cost of borrowing. It includes any fees or additional cost incurred to set up the facility. Asset. An asset is anything you own that has value and can increase or appreciate in value over time. An asset could include property, jewelry, artwork, investments, or precious metals such as gold, silver, and platinum. Balance transfer. A balance transfer is a type of credit card transaction that moves a balance from one credit card to another. Typically, the balance being transferred is held on a credit card from a different credit card issuer with an introductory period when the balance transfer attracts no interest for an agreed time. Bankruptcy. Bankruptcy is a legal proceeding initiated when a person or business cannot repay outstanding debts or obligations. Central bank. A central bank is a bank that controls the money supply in a country. It usually sets interest rates and decides how much money to print. The Bank of England, Federal Reserve, and European Central Bank are examples of central banks in the United Kingdom, United States, and Europe, respectively. Collateral. Something pledged as security for repayment of a loan, which can and will be forfeited in the event of a default. Compound interest. Compound interest is when the interest you earn on your money earns interest on itself. For example, you deposit £100 into an account, and 1 year later, your £100 is now £110. In year 2, you will earn interest on £110 instead of your original £100. Consolidation. Consolidation is a way of merging your existing debts into one convenient monthly payment. This can be a good option when you have multiple debts, for example, on credit cards or overdrafts, that you wish to pay off within a more defined time frame. Credit report. Your credit report is a digital record of your financial history. It contains records of all of your debts, your payment history, including missed and late payments, county court judgments, and other court records registered against you. The information in your report is used to derive your credit score. Credit score. A credit score is a number that shows the likelihood that you will pay back the money you borrow. Lenders use credit scores to determine whether to accept your application for credit facilities such as personal loans, mortgages, or car loans. They also use your credit score to determine what interest rate to offer you. Cryptocurrency or crypto. A cryptocurrency is a digital or virtual currency that uses cryptography to secure
Sample complete. Ready to continue?